Hello, Vitavia community. This is Hammer coming to you this week. It is August 30th, 2023, coming to you from the road. So I will not have a guest with me today, but we did want to make sure that we kept you guys all up to speed with what's going on with rates these days in the rate market. I know that many of you do tune in and see what's going on. If you're here live, say hello. Let me know that you're here. Love to see you in the comments. Let me know if you are a consumer or a vetted VA professional. If you're watching the replay, do us a favor. Just put a hashtag replay in the comments. Let us know that you were here. Don't forget that we can go ahead and answer any questions that you have if you do put them in the comments. I'm going to go ahead and load up the slideshow so you guys can see the slides with me. Bear with me a second. And let's see, share my screen. We're going to share this tab here. All right. There we go. Let me add this to the stream. Okay. So let me go ahead and let's see what happens if I may just do it this way for this week just to keep it easy. So anyway, let's go ahead and show you guys a quick recap of where we're at and where things have been and what's going on with rates. Quick thing on where we are, a recap on where rates have been. Rates have basically settled and even fell a little bit since last week. They actually did move up higher, then they started to come back down a little bit. VA rates are averaging the high sixes to the low sevens. Conventional rates are averaging the low to mid sevens, but can be in the high sevens in some situations as well. So keep that in mind as far as where we are at. Sorry about that. Anyway, so conventional rates averaging in the low to mid sevens, but they can be in the high sevens. If you're looking at your VA rates, you're going to find those are in the high sixes to low sevens. Let's go ahead and take a look here at the next slide. This week, all eyes are on the labor market. So basically, when I say that all eyes are on the labor market, what I mean is markets and traders are looking at what's going on with a lot of different reports. I'm going to share with you some of those reports so that you guys can see exactly what we're looking at. But they want to see a softening to the labor market because right now the Fed is trying to slow down inflation, and they're looking at inflation and they're looking at wages and the labor market, because when we have a really strong labor market, the economy is unlikely to slow down. And in order to slow that down, they want to see unemployment tick up a little bit. They want to see some more there. So this week, all eyes are on the labor market. We got a report yesterday called the JOLTS data. It comes from the Bureau of Labor Statistics. It is for job openings and labor turnover survey. It showed that there were less job openings than estimated, than anticipated. And the reason that actually was a good thing and actually helps your mortgage rates to improve a little bit, which we saw yesterday, is because it points to a less competitive job market, if there's less job openings and there's more of an equilibrium there. So we did see that report come in yesterday that way. Tomorrow, we're going to get what we call the PCE inflation data. That's the personal consumption expenditures. It's the one that the Fed looks at most closely as far as inflation. Now, in the past, we talk about the CPI inflation data, which is Consumer Price Index. A lot of jargon, but they're basically two different reports. This one, though, is very likely to mimic a lot of what we've already seen, very similar to what we saw from the CPI report that was earlier in the month, showing that inflation was slightly improved, but not improved tremendously. And that's kind of what we're expecting to see and where things will probably stay for a little bit on a more regular basis at this point. So we're going to see that report tomorrow. Now, we've seen a real shift in rates recently. The last few weeks, rates have been moving up higher and higher. We've seen the highest rates of the year. In fact, we've seen the highest rates since early in the aughts, back in the 2000s. So it's nice to see that mortgage rates are starting to actually come down a little bit. They're not likely to come down too much, though. So don't get too excited. Be careful that you're not trying to play the market and catch things at just the right time. We call that trying to catch a falling knife. It's a very difficult thing to do. So you want to make sure that you're not trying too hard to kind of see where things are at in that kind of a scenario. So as far as where we think rates are going to go from here in a quick rate forecast, let me give you some insight into where I think things are going from here. Let me go ahead and pop this up. Basically, rates could move a bit lower if the labor data points to a softening labor market. We're going to get a very big report on Friday. And that Friday report is going to show us non-farm payrolls. It's going to show us wages as well as unemployment numbers. And basically, over the next 15 days, rates could improve a bit. but they may move higher again. So we've seen rates just start to fall back a little bit, which is exciting, but it is very likely that we could see them creep up higher again the next few weeks. Rates are likely to move back a little bit higher than what we see today. We do have another strong inflation report coming up in a couple of weeks. I'll talk about that more next week. Long term, though, we're not going to see rates move significantly lower from here until sometime in 2024. It's just not likely. The reason that we're not going to see rates that are going to move all that much from here is because we still expect the Fed to most likely raise rates one more time, probably in November, and they're going to hold rates into 2024. They're not going to begin to actually improve that Fed funds rate, the Fed's policy rate, until much later in the year when they see the economy starts to slow down and we see a lot of these changes. All the Fed, rate increases that we've seen recently start to have more of an effect. So anyway, that's where we're at on everything. I hope this does help you all. I will be back in the office next week and we'll give you a little more insight then. You take care and make it a fantastic day and have a great week. And I'll see you next week. Bye-bye, everybody.